It's 2024, and if you're investing right now, one of the key questions that you might be asking yourself is, well, how do I create an investment plan that allows me to be diversified enough so I don't have too much exposure to some major market like the US? Because let's face it, there's a lot going on globally at this point in time, and diversification is now more than ever really, really important. So in this video, I've teamed up with XTB and we're going to talk about how you create an investment plan that avoids overexposure to a major market like the US. And I'm going to show you an example of what this might look like using their investing plan feature. If you are an investor right now, it is extremely hard to ignore the allure of the US market. And there are good reasons for that. They are the largest economy globally, which means that because of that illustrious title, when you look at global capital, when it comes to investment capital, they get the lion's share of that money. And the reasons are clear. When you look at the US economy, you look at sectors, for example. So let's have a look at tech, which has been a huge engine for growth globally over the past 5 to 6 years. Most of those companies are American-based, American-owned companies. So you have to look at the likes of Tesla, Amazon, Facebook, Microsoft, Alphabet, which is Google. And beyond that, when you start to look at the wider proposition of investing in the United States, so you have, indexes like, the NASDAQ, for example, or the S&P 500, which is hugely popular. The track record of these indexes paint a very, very rosy picture for investors. Now, we do know that past performance is no indication to future performance, but let's just take the S&P 500 as the example here and look at it from a 10-year stint between 2010 and 2020. Over that period of time, the S&P 500 had an annualized return of 13.6%. During that 10-year period, that decade, it tripled in value. And when you compare that to an index like the MSCI Global, which excludes the US, over that 10-year period, the performance of that index was between 5 and 7%. So it's not even close. And as an investor, if you're looking at where you want to place your money for the possible highest return, where your money can work as hard as possible for you, it is very, very hard to discount the US. But that in itself presents a bit of a problem. And that problem is the fact that you can have overexposure to the US market because it is so attractive, and it creates something called concentration risk. And if you don't know what concentration risk is, here's a definition for you. Concentration risk is the risk of loss because your investment is heavily focused in one area, such as a single stock, sector, or country, instead of being spread out or diversified. It means that if that area performs poorly, it can significantly impact your entire investment. Now, an analogy that I often use to try and explain this for people is the egg versus basket analogy. You may have heard this, but indulge me. So if you have one basket with one egg and you drop your basket with your egg in it, it is highly probable that you're going to break the one egg that you have. However, if you have a basket with 30, 40, maybe even 50 eggs in it, it is very, very probable that you're going to have a number of eggs that remain intact that you can use. And it is this idea of, okay, if the basket is the US economy, do you put all of your eggs into that one basket? Is it prudent to do so? It raises this question of diversification and how you can spread your eggs adequately, not just in the US, but across other regions globally. And whilst that might be a little bit difficult to be able to analyze and do, I'm going to show you an example of how this might work using the XTB app next. The theory and the idea of diversification is something that's been around for decades now, and the professionals use it all of the time to ensure that their portfolios are, number one, efficient, balanced, and on track to actually meet the goals and the objectives that they set for their portfolio. And as a retail investor, I think this often goes amiss because in order for you to have an investment plan, you kind of need to have an idea of what your goals and your objectives are, because those goals and objectives will determine exactly what you should be doing with your portfolio. But that is for you to decide. You need to have a good handle on that. But I'm just going to jump into the XTB app right now. And this is a demo account, by the way. But if you sign up and you use the live account, it won't be too dissimilar to this. I want to show you specifically their investment plans, which is actually in their Save tab, which you can find, which is the second icon here. You click on that. Now, I've already gone about in setting up an investment plan to start off with, but a couple of things that I do want to highlight for you just very, very quickly when you go in here. So I've already got the S&P 500 as part of my investment plan to start off with. We're going to tweak this as we go along. And one thing that I want to point out is when you go to manage up here, they have an option to auto invest. And what that basically means is that you can set up your portfolio or your plan, and you can allocate into your plan as many ETFs as you want. And within that, you can then also allocate how much of your money you want to go to each portfolio, giving you a diversification spread across those ETFs. Now, the beautiful thing about auto invest is if you do use this and you do sign up, when you send money on a monthly basis, the money that you send gets invested as you built into your investment plan using the app. So let me just go back really, really quickly. Like I said, I've already got the S&P 500 in here. Now, the S&P 500 is an interesting index because at the moment, as of recording this video, I believe there are 506 companies in the S&P 500. So across the US economy, there are also different sectors or industries. So you've got tech being the leading industry at the moment in the United States, but there are also other industries or sectors. So you've got real estate, for example, you're going to have financials in there, you're going to have healthcare. There's a whole slew of them. And by investing in the S&P 500, yes, you're investing in the US, which is one geographical region, which we're questioning, is that prudent that you have all your money in that one geographical basket? But within this, you're also going to be diversified across the various parts, sectors, industries in the US economy. And it's worthwhile just noting that. So if I wanted to build this investment plan out and I thought, okay, having 100% of my money into the S&P 500 across the various sectors in the US economy might not be right for me, and I want to add in some additional regions, parts of the world, or maybe even specific themes, how might I go about doing that? So all you need to do is you need to add ETF to the plan. Now, good thing about XTB is that they offer 0% commission on ETFs, which is really, really good. In the instance where you might be buying a ETF that is USD denominated, and you're obviously doing that in pounds, there is a commission for the currency transfer. I'll pop that on screen right here. That isn't to be unexpected. Most of the providers that are out there will charge the same commission for that transaction between pounds and the USD. Some will charge more, but it's really important to make sure you pay attention to that detail. But here on the screen is how much XTB actually charge. Now, let's just say I wanted to add in a few things here. I think ultimately I would want to maybe have, in this example, a global ETF so that I've got a little bit of a spread of exposure. So I'm going to click in this top one here, and to add it in, all you do is you click plus and then you go next. And this will add into the portfolio. Now, what it says here is that, you know, with the way it's currently allocated, there's 70% left of full allocation. So if I just do equal, it will mean that now I've got 2 ETFs in there and I've got 50-50 in the 2, right? So it's spread equally across. So for me, I might want to add in another region. So I might want to choose maybe emerging markets. So I've got some exposure to another part of the world, not just the US. Again, we're looking for diversification across regions in the world. So I might pick, for example, this iShares Core MSCI Emerging Markets ETF right here, which is this one. So again, I'm just going to click plus, I'm going to go next, and I'm going to ask it to equalize, which will put 33% into each of the 3 that I've got. I'm going to add one more. And for this one, I'm going to go more of a specialist theme, maybe. I'm going to maybe select something like, I don't know, let's have a look at blockchain technology, for example, okay? And let's see what they have in the blockchain technology, if there's anything at all. Yes, so there's this one from Invesco, Elwood Global Blockchain ETF. I'm going to click plus on that and go next. So I'm going to equalize for the time being. So now that we've got 4 ETFs in here, one thing that I do know looking at this is that, right, I've got exposure to the US. Within this, I also know that I've also got exposure to the US in the global MSCI index as well. I know that I've got some exposure to emerging markets, which is a completely different region of the world. And I've also got a very specialist ETF in here because I might have an interest in something like the blockchain. Yours might be AI, it could be anything else. But in trying to build a diversified portfolio that doesn't overexpose you to the US, what you might decide to do is tweak your allocation here. So at the moment, everything in this portfolio is equal, as you can see here. There are 4 ETFs with 25% each. Now, I do want exposure to the US, so I might decide that I want to crank this particular one up, the S&P 500, to 40%. I might decide that that's what I want to do. Now, it's telling me that I'm over allocated by 15%. I think for me personally, based on this exercise, I want to jack up how much my exposure is in the emerging markets part of this portfolio. So I'm going to put that up to maybe 30. Now, I know I've got a world index here as well, but I'm overexposed by 20% right now. So what I'm going to do is I'm going to reduce that down to 20%, but I'm also going to take down the blockchain because the blockchain is very much a specialist theme. And I might decide for this example that I would want less exposure. So I'm going to reduce this down to 10%. So across this investment plan right now, I have got 40% in the S&P 500, I've got 30% in an emerging markets ETF, I have got 10% in a blockchain ETF, and I also have another 20% in a global index, which is invested globally, which will still include some of the US. For me in this example, I would be happy with this. However, for you, you would need to do your research to find out what splits might you like. You might decide, well, actually, you want more in the emerging markets. You might want more in the blockchain. You might want less in the S&P 500, but more in the global ETF that we put in here. How you do this is completely down to you. But I think the important thing here is to stress the importance of diversification. Diversification and not putting all of your eggs in one basket is extremely important. And look, there is an even quicker way in which you could do this. You could say, actually, you know what, my premise is I want to start investing using a global approach, and you simply select a global ETF, maybe 2 or 3 of them, and then you do exactly what I've done here and just tweak your allocation to suit your needs. Speaking of which, let me show you a couple of other markets from across the globe and different regions to drive home this point about diversification and trying to avoid concentration risk within your investment plan or your investment portfolio. So the first graph I want to show you is for the Nifty 50. Now, the Nifty 50 is an Indian stock market, and as of the 19th of March 2020, it was trading at 9,587 points. As of the 13th of March 2024, it was trading at 21,981. That's a 129% increase. The second one is the Nikkei 225. Now, this is a Japanese stock market, and as of the 12th of March 2020, it was trading at 19,064 points. As of the 14th of March, it was trading at 38,780. Now, that is a 103% increase. The reason why I'm showing this is to say that, yes, the US is the largest economy in the world. However, it is not the only game in town. And as an investor, what you try to do is you try to place your money in places where you feel that you can counterbalance and, I guess, cast your net over the performance that you can get globally. Now, the problem is that if you only invested in the US, you potentially would have missed out on growth from both of those 2 regions that I've just highlighted there. And that will be fine as long as the US continues to perform. And that's really what you're trying to avoid. You're trying to avoid having all of your eggs in one basket, i.e. the US, and if it doesn't perform, you've missed out on other regions that may have performed well. The third thing that I want to show you is just going back to the S&P 500. Now, the S&P 500 has 11 sectors, and this is a graph of the performance of the S&P 500 through 2023. And as you can see here, the majority of the returns in the S&P 500 came from 2 sectors. It came from tech and it came from communication services, 56.4 and 54.4% respectively. If anything happened to those 2 sectors, potentially it sends your investment portfolio or your investment plan into the negative. And that's what we're trying to avoid. So there it is. That's just an example of what it might look like if you were to build an investment plan and diversification is going to be really important to you. It goes without saying. Please just don't go and copy what you've seen here for your own portfolio. It is really, really important you're guided by your goals and your objectives. You understand obviously your risk and your timeline, how long you're looking to invest for, because those are the factors that will really determine how you should invest and how you should diversify your portfolio. Research is needed. So make sure that you do further reading, make sure that you understand exactly what it is that you're doing. But that's just an example that I've just showed you right there. If you do want to use XTB, there is going to be a link down in the description and also pinned in the comments. Go sign up, it's completely free, have a little play around and see how this might plug into your investment journey, because it may just offer you some tools that you don't have access to currently. I would also love to know, and this is a question for you, if you're invested currently right now, where is your region of choice? Are you all in the US? Are you confident about the US? Or are you more bullish on the emerging markets? Are you more bullish on the UK? I don't really know that many people that are, but are you bullish on the UK? Are you bullish in Europe? Where do you see, what region do you see being the growth engine for the next 2-3 years? I'd love to know, let me know in the comments down below. Thank you so much for watching this video. Catch you later on.